Welcome. My name is Rob Lane. I'm the managing shareholder of Kirkring Barbario, and we're very excited to share with you some of the new information around the One Big Beautiful Bill Act, or as we'll refer to it as OB3A. Just a little bit about our firm for those of you that may just be meeting us for the first time. We are headquartered in Sarasota. We have offices in Lakewood Ranch as well as Tampa and have been serving the region for over 52 years. We have a number of specialty areas, but throughout this series, we'll be really just focused on our tax, whether that's for individuals, whether it's businesses, and so we also know that this bill is evolving. We're getting information continually about clarifications. So stay tuned and we will continue to bring you information as it becomes available. So at this time, let me turn it over to Aaron Fuller and Elizabeth Gladstone to talk about some of the effects for individuals.
Thank you, Rob, for that introduction. My name is Erin Fuller, and I'm a manager here on the Estate and Trust Department. And as Rob explained, Elizabeth and I are very excited to introduce a series of videos dedicated to the individual tax provisions within the One Big Beautiful Bill Act, or OB3A, as we like to call it. So this legislation was just signed into law. It was signed on July 4th, 2025, and it has permanently extended many of the provisions that we saw within the Tax Cuts and Jobs Act of 2017, or TCJA. But TCJA was only put in place between 2018 and 2025, so many of those provisions were set to expire or sunset at the end of 2025. So this created a lot of uncertainty for our tax planning. We didn't know where we were going to end up at the end of 2025. We didn't know if we were going to return to 2017 numbers indexed for inflation or where we were going to end up. So now with this permanent extension of many of the provisions within the Tax Cuts and Jobs Act, it creates a much more stable and predictable tax policies that we can begin to open up those conversations again on how to do proper tax planning. So what are the provisions within OB3A that have been made permanent? So we can continue to enjoy the retention of our 7 marginal tax brackets, the lowest tax bracket being 10%, the highest tax bracket being 37% for individuals. So prior to the TCJA, we had a 39.6% tax bracket being our highest individual tax rate, and that is no longer. 37% continues to be the highest tax bracket under OB3A. We also see the preservation of the expanded standard deduction. Now, prior to TCJA, we had a standard deduction of not quite half, but nearly half of what it is today. Within OB3A, we can continue to see that expanded larger deduction. And this has actually made it where many taxpayers no longer itemize, and it's more beneficial for them to just take the standard deduction. But for those that do itemize and will continue to itemize, we will see the continuation of the $750,000 mortgage interest limitation for acquisition indebtedness still in place with OB3A. We also see the permanent suspension of certain miscellaneous itemized deductions. What are those? Well, the most common expense that we saw that was a certain miscellaneous itemized deduction was investment management fees. Those are large fees that taxpayers pay to their brokers for their investment management fees. Well, those continue to be disallowed as for both individuals and for trusts. Also staying there within that estate and trust realm, we see the permanent increase of the federal estate, gift, and GST exemption to $15 million. And this is going to be effective 1/1/2026. So you're going to say $15 million. That's a lot of money. I'm not going to even have nearly anything close to that. So I don't need to do estate planning, or I don't need to consider my annual gifting and things like that. That couldn't be further from the truth. And our estate and trust team leader will explain in a future presentation why that is not the case. I've just reiterated a million times that these provisions are made permanent by OB3A. I have to tell you with extreme caution, all tax policies are subject to future repeal, future changes by future legislatures. So we have to enjoy these provisions while they're in place, but are they truly permanent forever and ever? No, they're subject to change by future Congresses. We can at least enjoy them while they're still in place. Through this series, we hope to equip you as a taxpayer with essential questions to ask and to consider, dispel any myths or misconceptions that you may have heard, and also identify planning opportunities where they exist. We also want to tell you to exercise extreme caution. Now, OB3A went through many iterations before it was finally signed into law. From initial proposal from what went to the Congress, what went to the Senate, what went back to the Congress, and then ultimately to the president's desk, it changed many times. So please be assured that you're using the correct information, the most up-to-date information, and what was actually signed into law, not just something that you gleaned from a headline or something that you overheard in a casual conversation like on a golf course in a supermarket, because what may apply to me may not apply to you as a taxpayer. There's a lot of nuances and caveats in each of these provisions. So please exercise extreme caution, and we truly encourage you. This series is intended to open the dialogue between you and your tax professionals and to know where planning opportunities exist. So now I've spent a lot of time explaining to you all the policies that have been made permanent and that basically were renewed by OB3A. Now Elizabeth's going to explain the completely new provisions that exist within OB3A.
Hi, my name's Elizabeth Gladstone, and I'm a senior accountant on the healthcare team here at Kirkring Barbario. So the new provisions under the OB3A, there are several. We're going to start with the new senior bonus deduction, and that's for individuals who are age 65 and older. We have a new deduction for tips, which applies both to W-2 employees and independent contractors in industries that customarily receive tip income. There's also a new deduction for overtime pay, but keep in mind that only the 0.5 premium portion of time and a half is eligible for the deduction. We also have a new auto loan limited interest deduction, which will apply to vehicles with final assembly in the United States. Trump accounts, which are child savings accounts for children from birth to 18 years of age. We have charitable contribution limited deduction, which is provided for individual taxpayers who do not itemize. And those are the new provisions. So these provisions are temporary. Almost all the provisions mentioned previously go into effect for the 2025 tax year and will remain in place through 2028, except for the charitable contribution deduction, which will go into effect for the 2026 tax year. Thanks for joining us today. Be sure to stay tuned for our upcoming videos where we'll take a deeper dive into each of these provisions and what they might mean for you. In the meantime, if you have any questions, please contact Erin Fuller or your KB representative. Until next time.